Today we are moving into Chapter 2, Supply Chain Information Technology. In Chapter 1, we discussed the broader idea of supply chain management, how firms coordinate suppliers, manufacturers, distributors, retailers, and customers to deliver value. We also talked about integration, synchronization, responsiveness, and risk. Now, in Chapter 2, we shift our attention to one of the major enablers of modern supply chain management, information technology. A modern supply chain cannot operate effectively without timely, accurate, and accessible information. In many ways, supply chain management today is not only about moving products, it is also about moving information. The physical product may move through trucks, warehouses, factories, and stores, but the decisions behind those movements depend on data. So, as we go through this chapter, keep this central question in mind: how does information technology make supply chains faster, more visible, more integrated, and more responsive? Before we examine specific technologies, let us first look at the learning objectives for this part of the chapter. This section has 4 main objectives. First, we will illustrate the overall framework for supply chain information technology. This means we will look at how information systems support different levels of supply chain activity, from basic transactions to strategic planning. Second, we will describe the major components of supply chain information technology. These include transaction systems, enterprise systems, planning systems, visibility tools, and other digital applications. Third, we will discuss how these components are integrated to support supply chain processes. Integration is important because supply chain decisions often require information from multiple areas, such as sales, operations, finance, inventory, purchasing, and logistics. Fourth, we will briefly discuss the role of blockchain technology in the supply chain. Blockchain is not the entire focus of this section, but it is one example of how emerging technologies may improve traceability, transparency, and trust across supply chain partners. The key point is that information technology is not just a support function, it is a core part of how supply chains are designed, managed, and improved. To understand why information technology has become so important, we first need to consider the broader technological advances that have transformed supply chain and logistic operations. Several technological advances have reshaped supply chains. One major advance is computer miniaturization. Devices have become smaller, cheaper, and more powerful. This allows companies to place computing capability in warehouses, trucks, handheld scanners, mobile devices, and even products themselves. Second, the internet and low-cost information transmission have made it much easier for companies to communicate with suppliers, customers, and logistics partners. In the past, information exchange was slower, more manual, and more expensive. Today, firms can transmit data almost instantly across the world. Third, we see the growth of omnichannel supply chain operations. Customers now interact with companies through stores, websites, mobile apps, marketplaces, and delivery platforms. This creates more complex fulfillment requirements because inventory and information must be coordinated across multiple channels. Fourth, technology has increased information sharing capabilities. Supply chain partners can share demand forecasts, inventory levels, production plans, shipment status, and point-of-sale data. Fifth, robotics has changed warehousing, manufacturing, and distribution operations. Robots can support picking, packing, sorting, movement, and repetitive production activities. Finally, tablets and mobile phones now allow employees and managers to access supply chain information from almost anywhere. This supports faster decision-making and better operational visibility. The main message is that technological progress has changed what supply chains can do. Faster information flow allows faster physical flow. These technological advances lead directly to a new standard for what supply chain information should look like. That brings us to the characteristics of modern supply chain information. Modern supply chain information should have several important characteristics: speed, accessibility, accuracy, relevancy, and simplified access. Speed means information should be available quickly. If a shipment is delayed, managers need to know early enough to take corrective action. Accessibility means information should be available to the people who need it. This may include managers, warehouse workers, salespeople, suppliers, carriers, and customers. Accuracy is essential because poor information leads to poor decisions. If inventory records are inaccurate, a company may promise products it cannot deliver or produce items it does not need. Relevancy means the information should be useful for decision making. More data is not always better if the data is not meaningful. Simplified access means users should not need overly complex procedures to retrieve information. Good information systems make the right data easier to find, interpret, and use. The Internet provides a common and economical platform for both business-to-business and business-to-consumer transactions. Internet browsers have become a common standard for exchanging information between partners. 3D printing can enable a type of physical product transfer across the Internet. Instead of shipping a finished product, a firm may transmit a design file, and the product can be printed closer to the point of use. Finally, the global Internet allows worldwide execution and tracking. A company can monitor inventory, orders, and shipments across continents. Once information becomes faster, more accessible, and more accurate, the nature of business itself begins to change. That is why we often describe the current period as the digital or information age. The digital or information age began in the late 20th century and continues into the 21st century. This period is characterized by connectivity among collaborating organizations. Companies are no longer limited to internal systems. They can connect with suppliers, logistics providers, customers, financial institutions, and regulatory agencies. This connectivity has been a major driver of supply chain management advancement. In earlier periods, supply chains were often managed through paper records, phone calls, faxes, and fragmented systems. Today, supply chains increasingly rely on integrated digital platforms. The shift from Industry 4.0 to Industry and Supply Chain 5.0 reflects this evolution. Industry 4.0 generally emphasizes automation, data, connectivity, cyber-physical systems, and smart manufacturing. Supply Chain 5.0 adds a broader emphasis on human-centered systems, resilience, sustainability, and collaboration between people and intelligent technologies. The fundamental outcome is that companies can often achieve greater coordination, faster service, and better decision-making at a lower total cost and with fewer financial resources. The primary enabler of these changes is information technology. Information technology changes business structure and strategy because it changes what firms can know, how quickly they can act, and how closely they can coordinate with others. As technology changes what firms can do, it also changes what customers expect. This leads to new performance standards. Modern supply chains face much higher performance expectations than in the past. Customers increasingly expect products or solutions to be developed to exact specifications. This is related to customization and personalization. They also expect rapid global delivery, A product may be designed in one country, produced in another, stored in a regional warehouse, and delivered to a customer somewhere else. Precise time delivery capability is increasingly important. In some industries, being early is not necessarily good if the receiving facility is not ready. Being late may shut down production or disappoint customers. Orders may now be fulfilled in hours. This is especially visible in e-commerce, grocery delivery, and local fulfillment models. Another important shift is from frequent service failures towards zero defect or Six Sigma level performance. In supply chain terms, customers increasingly expect the perfect order. A perfect order means the right assortment, the right quantity, the right location, on-time delivery, damage-free condition, and correct invoice. Modern supply chains cannot exist without information systems. Without information systems, it would be almost impossible to coordinate the speed, complexity, and accuracy required in today's supply chains. Now that we have established why modern supply chains depend on information systems, let us look more directly at the critical role of information technology in supply chain operations. Information technology is a major enabler of supply chain management. It initiates transactions. For example, when a customer places an order, the system records the order, checks inventory availability, assigns product, schedules fulfillment, and triggers other downstream activities. It tracks processes. A company can monitor order status, shipment location, production progress, and warehouse activity. It facilitates information sharing both internally and externally. Internally, different departments can access common data. Externally, suppliers, customers, and logistics partners can coordinate more effectively. It also supports oversight and decision-making. Managers can use information systems to identify bottlenecks, measure performance, and evaluate alternatives. Comprehensive systems include transaction support, decision support, and communication. This is important because information technology is not only about recording what happened. It also helps managers decide what should happen next. Historically, many firms focused on products and physical operations, while information flow was often overlooked because manual systems made information difficult to collect and use. Today, information flow is central. Redirecting shipping containers mid-transit is one useful example. If a firm knows demand has changed or a destination is congested, it may redirect a shipment while it is still moving. That kind of decision requires real-time visibility and coordination. There are 5 major reasons information is critical. First, customers demand real-time data. Customers want to know whether products are available, when orders will ship, and when deliveries will arrive. Second, information reduces the need for excessive inventory and human resources through better planning. If a firm has better demand and inventory visibility, it may not need to hold as much safety stock. Third, information increases flexibility and competitive advantage. A company with better information can respond faster to disruptions, demand changes, or customer requests. Fourth, the internet enables collaboration. Supply chain partners can exchange data, coordinate plans, and monitor execution more easily than before. Fifth, information enhances transparency and visibility. Managers can see where inventory is, where shipments are, and where problems may occur. Together, these points show that information is not merely administrative. Information directly affects inventory, service, cost, flexibility, and strategy. To organize these roles more clearly, we now turn to the framework of Supply Chain Information Systems, or SCIS. Supply Chain Information Systems serve as an integration thread for logistical processes. The foundation is transaction systems. Transaction systems support formalized, high-volume, day-to-day activities. Examples include order entry, inventory assignment, order selection, shipping, pricing, invoicing, and order inquiry. These activities may seem routine, but they are essential. If transaction data are inaccurate, then higher-level decisions will also be flawed. For example, if inventory records are wrong, planning systems will recommend the wrong replenishment quantities. The second level is management control. This level focuses on performance measurement and reporting. Managers track costs, service, productivity, quality, and asset utilization. Management control also includes exception reporting. Instead of reviewing every single transaction, managers can focus on situations that fall outside acceptable limits. For example, the system may flag a late shipment, low inventory level, or abnormal cost. Once the system can record transactions and monitor performance, the next question is how managers use that information to evaluate decisions and plan strategically. The third level is decision analysis. Decision analysis includes tools used to evaluate alternatives. Examples include supply chain design, inventory management, resource allocation, routing, and profitability analysis. This level often uses databases, modeling tools, and reporting systems. For example, a firm may analyze whether to open a new distribution center, change transportation modes, or adjust inventory policies. The fourth level is strategic planning. Strategic planning synthesizes data to evaluate long-term direction. This may include alliance formation, capability development, and customer relationship opportunities. The key idea is that supply chain information systems support decisions at multiple levels. At the bottom, they handle daily transactions. At the top, they support long-term strategy. A strong SCIS depends on all four levels. Without accurate transaction data, strategic planning may be unreliable. Without strategic planning, transaction efficiency alone may not create competitive advantage. A good supply chain information system must support both execution and planning. At the execution level, the system helps the organization process orders, assign inventory, manage shipments, update records, and communicate with customers and partners. At the management level, the system helps monitor performance, identify exceptions, and support corrective action. At the decision level, it helps evaluate alternatives and improve operations. At the strategic level, it helps the firm make larger decisions about supply chain design, partnerships, capabilities, and customer service strategy. This framework reminds us that information systems are not only technical tools, they are management systems. They determine what information is available, who can see it, how decisions are made, and how quickly the organization can respond. Now that we understand the four levels of SCIS functionality, let us consider how investment priorities in supply chain information systems have evolved over time. Historically, firms invested in supply chain information systems, mainly to improve transaction efficiency. That means the goal was to process transactions faster, reduce clerical work, reduce errors, and lower administrative costs. These benefits were important, especially when many processes were manual. However, the current investment focus has shifted. Many firms have already captured much of the basic transaction efficiency improvement. Today, the emphasis is increasingly on integration and better decision-making. In other words, companies are no longer asking only, can we process orders faster? They are also asking, can we use information to make better decisions across the supply chain? Major cost categories include hardware, software, communications, and human resources. This reminds us that information systems are not free. They require technology investment, system maintenance, employee training, process redesign, and managerial commitment. Therefore, firms need to evaluate information technology not only as a cost, but also as a strategic investment. A major reason firms invest in these systems is the complexity of global supply chains. Let us now examine the key information exchange functions needed in global operations. Several key information exchange functions are needed in global supply chains. The first is data capture. Data must be collected from many sources, often 24 hours a day. This may include scanner data, sensor data, order data, shipment data, production data, and customer data. Accuracy is especially important in difficult environments, such as ports, warehouses, factories, or outdoor transportation settings. The second is data transmission. Data must move across locations and systems. This may involve satellite communication, the internet, Bluetooth, mobile networks, or other technologies. Global operations create challenges because of volume, distance, infrastructure limitations, and environmental conditions. The third is transaction initiation and monitoring. Supply chains rely on forecasts, orders, shipping notices, production signals, and payment documents. If these systems fail, operations can be seriously disrupted. A system failure may prevent orders from being processed, shipments from being released, or suppliers from receiving replenishment signals. The fourth is planning and collaboration support. Firms must share data for replenishment, delivery planning, production scheduling, and demand management. However, collaboration can be difficult when partners use different systems, data definitions, or security protocols. The overall point is that SCIS integrates activities into a seamless global process. The supply chain may be physically spread across the world, but information systems help connect it into one coordinated system. After discussing information exchange globally, we can now summarize the key activities a supply chain information system must perform. A comprehensive supply chain information system has three core purposes. First, it initiates and monitors activities. This includes orders, shipments, inventory movements, production activity, purchasing activity, and customer service processes. Second, it assists in decision-making. It helps managers evaluate options, identify problems, compare alternatives, and select better courses of action. Third, it reports on operations and planning. Reporting allows managers to track performance, compare actual results with targets, and communicate results across the organization. These three purposes are closely connected. For example, a system may initiate an order, monitor the shipment, report a delay, and help the manager decide whether to expedite delivery. This is why SCIS should be viewed as an active management tool, not merely a database. To understand how these activities are organized, we next look at the overall architecture of a supply chain information system. Architecture refers to the structure of the system, how different components are connected, how data flow among them, and how they support supply chain processes. A typical SCIS architecture includes enterprise systems, supply chain execution systems, planning systems, visibility systems, and communication links with external partners. The architecture matters because supply chain processes cross functional boundaries. A customer order may involve sales, inventory, warehouse operations, transportation, finance, and customer service. If systems are disconnected, the process becomes slower and more error-prone. A well-designed architecture allows data to flow across functions and partners. This supports integration, visibility, and responsiveness. At the center of many supply chain information architectures is ERP. Let us now discuss ERP as the backbone of SCIS. ERP stands for Enterprise Resource Planning. ERP systems became especially important as firms replaced older legacy systems in the 1990s. Legacy systems were often fragmented, meaning different departments had separate systems that did not communicate well with one another. ERP systems use integrated transaction modules and a common corporate-wide database. This allows different functions to work from consistent data. ERP systems store both current and historical data. This includes operational data such as orders and inventory, as well as financial data such as costs, invoices, and payments. ERP systems facilitate several key supply chain transactions, including order entry and management, inventory assignment, transportation, order fulfillment, and replenishment. The major advantage of ERP is consistency. If sales, operations, inventory, and finance all use the same data, the organization is more likely to act in a coordinated way. ERP systems do not only support supply chain execution, they also connect supply chain operations with broader business functions. ERP systems also support financial, accounting, and human resource functions. This is important because supply chain activities have financial and organizational consequences. For example, purchasing creates supply obligations. Shipping and delivery affect invoicing. Inventory movements affect asset values. Labor assignments affect staffing and payroll. ERP systems also support data mining, knowledge management, and enterprise integration. Data mining helps firms identify patterns in customers, products, demand, operations, and costs. Knowledge management helps firms capture and use organizational knowledge. Enterprise integration helps connect different parts of the business. ERP can generate insight on customers, products, and operations. This means ERP is not only a recording system, it can also support analysis and improvement. Because ERP connects supply chain activity with the rest of the business, we need to examine some administrative and financial modules that may not look supply chain specific, but are still very important. Some ERP modules are not supply chain specific, but supply chain operations interact heavily with them. For example, supply chain managers may not directly manage accounting or human resources, but their operations generate financial transactions and require personnel decisions. Supply chain activities must fit within the company's information framework, reporting structure, accounting rules, and organizational design. This is why enterprise integration matters. If the supply chain operates separately from finance, accounting, HR, and administration, then the firm may have inconsistent information and poor coordination. A supply chain decision may look operational, but it often has financial and organizational consequences. The first component is general administration. This defines the information framework, transaction process flows, reporting structures, and organizational setup. Supply chain operations use this framework to define processes such as customer order fulfillment and replenishment. The second component is accounts receivable and accounts payable. Accounts payable is connected to materials and services acquired from suppliers. When purchasing orders materials, the company eventually needs to pay suppliers. Accounts receivable is connected to delivery and invoicing. Once an order is delivered and completed, the company invoices the customer and expects payment. The third component is financial inventory accounting. Inventory is both a physical supply chain resource and a financial asset. The timing and location of activities such as production, packaging, customization, and inventory movement affect financial reporting, tax reporting, and stock valuation. For example, whether inventory is recorded as raw material, work in process, or finished goods can affect financial statements. The key lesson is that supply chain activities are deeply connected to financial systems. The general ledger structures detailed accounts for revenue and cost monitoring. This influences the supply chain's ability to measure and report costs related to customer value delivery. For example, if a company wants to know the cost to serve a particular customer segment, it needs accurate cost data. The Human Resources module tracks personnel profiles, pay and benefit scales, and activity levels. This is highly relevant to supply chain operations because supply chains often involve large workforces in manufacturing, logistics, purchasing, warehousing, and transportation. Labor availability, skills, training, and cost all affect supply chain performance. For example, a warehouse cannot improve productivity only by adding technology. It also needs trained workers, appropriate staffing, and effective supervision. The broader point is that supply chain management depends on enterprise-wide information, not only logistics data. Now that we have discussed enterprise administration and support modules, let us move into the core modules that directly support supply chain operations. The first core module is Customer Relationship Management, or CRM. CRM facilitates information sharing between customers, the sales force, and operations. This helps the firm understand demand, customer needs, service requirements, and sales opportunities. The second is logistics. Logistics systems direct and monitor finished goods inventory, warehouse management, transportation management, and yard management. The third is manufacturing. Manufacturing systems schedule production resources and determine material requirements. The fourth is purchasing. Purchasing systems initiate and track purchase orders, expediting, and supply management. The fifth is inventory deployment. Inventory deployment systems schedule and monitor material flows for production and distribution needs. Together, these modules help connect customer demand with operational execution. When these modules are integrated, a customer order can trigger inventory assignment, warehouse activity, transportation planning, replenishment, purchasing, and financial transactions. These core modules handle much of the day-to-day execution. However, supply chain management also requires planning and monitoring beyond daily transactions. That brings us to enterprise planning and monitoring. Enterprise planning and monitoring includes the processes and systems that enable planning and coordination information to be exchanged. This exchange occurs internally across firm functions and externally with supply chain partners. Internally, sales, operations, finance, manufacturing, logistics, and purchasing must coordinate. Externally, the firm may need to coordinate with suppliers, carriers, distributors, retailers, and customers. The key requirement for success is substantial standardization across internal functions and supply chain partners. Standardization matters because systems cannot communicate effectively if different partners use inconsistent definitions, formats, calendars, or performance measures. For example, if one partner defines on-time delivery differently from another partner, performance reporting becomes confusing. This idea helps us see the bridge between execution and strategic planning. A firm must execute daily operations, but it must also coordinate future plans and monitor performance. Three key modules support this planning and monitoring role: sales and operations planning, supply chain visibility and event management, and supply chain compliance. The first is sales and operations planning, often called S&OP. S&OP balances demand requirements with supply capabilities. It requires cross-functional coordination because demand plans must be matched with production, inventory, purchasing, labor, and logistics capabilities. For example, if sales expects demand to increase next month, operations must determine whether the company has enough capacity, inventory, suppliers, and transportation resources. The second module is supply chain visibility and event management. This involves real-time tracking of in-transit shipments and proactive recommendations to avoid disruptions. For example, if a shipment is delayed, the system may suggest rerouting, expediting, or reallocating inventory from another location. The third module is supply chain compliance. Compliance systems monitor product and component flows to ensure adherence to regulatory requirements, such as labeling, taxation, safety, security, and documentation rules. Again, the key requirement for success is standardization across internal functions and supply chain partners. At this point, we are moving from day-to-day execution to proactive planning, visibility, and regulatory alignment. These capabilities set the stage for more advanced technologies, such as blockchain. To close this part of the lecture, let us summarize the overall message. Supply chain information technology begins with transactions, but it does not end there. It supports execution, management control, decision analysis, strategic planning, enterprise integration, visibility, collaboration, and compliance. A modern supply chain is only as strong as the information that supports it. If information is slow, inaccurate, incomplete, or fragmented, the supply chain will struggle. But when information is timely, accurate, shared, and integrated, the supply chain becomes more responsive, more efficient, and more competitive.